Good evening, Aussie expats, both in America and also in other parts of the world. We've actually got quite a few attendees this evening, both dialing in from east to the west coast of the United States, Australia, and believe it or not, Europe as well too. So thank you very much for giving Ashley and myself your time. My name's Brett Evans. I'm the Managing Director of Atlas Wealth Management. Joining me this evening is Ashley Murphy of Arete Wealth Australia. What we wanted to do this evening is, we know your time's incredibly valuable, so we don't want to waste anyone's time. What we want to do is for people to walk away from this evening with a bit more information than before the webinar. These webinars are successful on the back of audience input, so you'll see that you can ask questions. Please ask questions, because I dare say if you have a question that other people will have the same question as well. So what we're going to do this evening is I'm going to introduce Ashley. Ashley will talk about the do's and don'ts from a US point of view, and then I'll come back and cover off on the Australian side, and then we'll throw it open to questions at the end of the seminar. Once again, just a couple of housekeeping things. Audience participation is encouraged, so please, get out there and ask any questions that have always been in the back of your mind. Without further ado, I'll hand it over to Ashley. Good evening, Ashley.
Hi there, Brett. Yep, can you hear me okay?
Certainly coming on loud and clear. So I'll hand it over to you and let you get the show on the road.
Wonderful. Okay, that's great. That's perfect. All right, excellent. Well, I'll get on with it then. So no presentation from a financial advisor we complete without our disclosures. But just a quick background about me, how I came to be here in the United States and dealing in this very specialized marketplace. Born in England, raised in Australia, moved to the US in 2005, worked in corporate finance, including for Babcock and Brown for a brief period. And since 2008, I've made a career as a financial advisor. Arete Wealth Group, which are the two brands that are under, Arete Wealth Group has two brands, which is Arete Wealth Australia and Arete Wealth Strategists. So we're a paperless and operate with digital processes for everything that we can. We have a presence in Minneapolis and San Francisco. I'm coming to you from our Berkeley location today. Obviously, Arete Wealth Australia is focused on the needs of Australian expatriates in the United States. And I have clients all over the country. And Arete Wealth Strategist is a domestically focused registered investment advisor, meaning we have a fiduciary obligation to our clients to serve their best interest. So we really act as the general financial contractors for Aussie expats. And I was saying to Brett just the other day, in the past week, between 3 different clients, I've had to provide advice or referrals in every one of these areas except for estate and charitable gifting. So the kind of work we do is really bringing it all together, saving our clients time, adding value in all these different ways. And we work with a broad range of partner firms to make this happen. And I'll just get straight into it. So do's in the US. Here's what we want to focus on is investments. That's very much a do in the US. It's same with insurance, mortgage if you're interested in buying property, employee benefits, make full use of them. Equity compensation, take full advantage, but be mindful of the taxes. Tax returns, do it properly, and use an expat, a qualified expat accountant who understands all the credits and exemptions and so on and so forth. So first thing, to do with investments and actually many of the major points that I have here, we can't let the tail wag the dog. You'll see the circumflex I have down the bottom here is do investments in the US. Make the US your primary location for investment after it's clear to you that the US is going to be your primary domicile, meaning this is where you see yourself staying for a good period of time. Maybe not the...
You there, Ashley? I think you just cut off there.
Sorry, Brett, did you say something?
Yeah, I think your line just dropped out there. You might want to repeat that last section.
Oh, okay. Well, I'll start from the top of the page then. Was it from there or was it from earlier that I cut out?
No, it was only the last probably 45 seconds.
Okay. So it's just saying it's very important to make sure that you're clear on where you're going to be for the next 5 or 10 years. You must let your domicile guide these decisions, not the relative advantages of one country versus another. You need to make sure that your entire life circumstances are going to be aligned and that you're going to be in a place for a good period of time. So that certainly applies to investment management. The U.S. has the most developed capital markets and infrastructure in the world. Therefore, it's highly competitive with low cost and high transparency, relatively speaking, always looking for more transparency to facilitate our investors and their investment experience. Many different investment vehicles that you may choose to make investments with. Margin lending is very competitive with certain brokerage houses. Prior to Janet Yellen's announcement last Thursday, we were looking at the highest rate for margin lending for one of the brokerage houses we use of 2.16%. But don't take this claim from me about the U.S. being the most developed capital market in the world. Take it from Morningstar, the 2015 global study, Global Fund Investor Experience Study showed that is in fact true, tied with Korea, with Aussie, with Australia taking the silver medal there. So next, how would you actually obtain investment advice? Well, many people that are settled in the U.S. are going to talk with their local Morgan Stanley Merrill Lynch investment advisor, and they can do a decent job for domestic clients, but the area of expat planning is very specialized, and there are many pitfalls, and so that's where it pays, particularly for the established client, to engage in our services, especially considering the fees are approximately the same. Another do in the U.S. is insurance. Yet again, you want to make sure that your domicile is going to be here. Life insurance. Very often, Brett and I are often talking about this, and Brett will be covering this in his part of the presentation, but life insurance is a very funny one given the tax deductibility of doing life insurance inside of a superannuation account. That would lead you to think, if it's tax deductible, surely it's going to be a better place to do life insurance. Not the case. The U.S. is far cheaper on a cost per $1,000 of coverage. I ran this myself in preparing for this presentation, just did a sample study of $500,000 on a 20-year fixed-term policy, and it was 40% cheaper in the U.S. Compared with doing the same policy in Australia. Also, the death benefit is paid tax-free to any domestic beneficiary, compared with needing to prove that you're a dependent in Australia, otherwise a 15% tax applying. Also, the creativity that comes with certain riders. Riders is the term used in insurance for optional extras. I've written a white paper here that we're submitting to the Journal of Financial Planning on chronic and critical riders on term life insurance. Now, that I'm sure is just a bunch of jargon to many people out there, but I'll break it down. So with term life insurance, the only way you're ever going to see any money is if a very sad event occurs and someone passes away. With these riders, chronic and critical, that's to say if you have a much more likely event occur, namely a cancer, heart attack, or stroke, you can actually accelerate the portion of the death benefit from your term life policy and receive funds that you would never otherwise seen with the traditional life insurance policy. That's just an example of one of the many different riders that are out there. Looking at disability insurance otherwise known as income protection insurance in Australia, exactly the same thing. Very flexible, many different riders are available, compassionate care, that's to say you can actually be on claim, receive a benefit yourself if you take time off work to support a loved one with their sickness. That is one of the riders that's offered on certain disability contracts in the U.S. There's even one carrier with no overseas claim exclusion. Yet again, another technical detail, but many disability insurance carriers in the U.S. and in Australia have an exclusion where you can't be overseas to actually receive the claim. They will require you to repatriate yourself to the country of origin of that disability policy. And there's actually a carrier in the U.S. where they don't have that, which is to say you could go on claim overseas and stay overseas and continue your claim. Long-term care insurance doesn't exist in Australia, does exist in the US. This is a form of insurance that provides for aged care. So if you have parents or you're perhaps in your 50s or 60s concerned about how you're going to pay for the cost of aged care, that's what long-term care insurance is. Liability protection, clients with a significant net worth, this becomes an increasing issue in a very litigious society such as the US. Very easy for claims to get attached to you. Acts of your children you end up being responsible for. And as your presence increases in the public eye, so does your liability exposure. Also, it's surprisingly cheap for that kind of coverage. A mortgage, yet again, you've got to be really considering staying in the US for a while before you even think about a mortgage. But here are some of the main advantages that mortgages have over purchasing via cash or compared with purchasing real estate in Australia. Generally, lower interest rates, more flexibility in the design of the mortgage. There are many different mortgage products out there. One area, however, where Australia absolutely has the US beat, and I've been trying to convince every mortgage broker I talk to and that will listen, and some that won't, about the mortgage offset account. I think that's a fantastic invention that is available on mortgages in Australia that's not available here. But the big advantage of mortgages in the US is it's tax deductible. Up to $1 million with another $100,000 in a home equity line of credit that can actually be deducted against your mortgage, which for higher income earners, those in the highest income tax bracket, therefore earning about $550,000, married, filing joint, that reduces, assuming a 4.25% interest rate, that reduces your tax equivalent yield. That means the reduction that you receive as a result of this being tax deductible, that means your tax equivalent yield on your mortgage interest rate is about 2.65% on a 4.25 interest rate. So that really changes the dynamic and makes mortgages a good, air quotes, form of debt. And therefore, as a result of that tax equivalent yield and the deductibility of the interest, you're likely to earn a higher rate of return on investments than putting cash down. Anyone that's been in the US for a period of time will know about employee benefits. For various historical and competitive reasons, it's become a major component of one's package when they consider employment at different companies. So common benefits you'll see mostly everywhere. Health insurance, that's if a company is serious about recruiting, they're going to offer health insurance. One thing that Australians new to the US would do well to appreciate is health insurance is not tax deductible if you're unemployed or new to the country. If, however, you have a small business, you're self-employed, or you're working for a company, that in fact is a tax deductible expense to them. So therefore, it's advantageous to obtain it through your employer compared with paying for it with after-tax dollars. Group life and disability, that's a very common employee benefit. A 401k is in fact an employee benefit. This is not a standard benefit that's written into the tax code or written into law, as is the case in Australia. Your company must in fact sponsor a 401k, and 401ks between employers can differ enormously with profit sharing amounts, with matches, with vesting periods. There's all sorts of differences between employers, and you can come across definitely better 401ks and not as good 401ks. But generally speaking, the tax deductibility of a 401k, however ordinary and limited the investment choice may be, it can often make it a good move for folks to consider. Flexible spending accounts. These are a lovely benefit. They allow for up to approximately it's like $27.50, $26.50 a year, tax deductible to be spent on health-related expenses, dependent care, up to $5,000 a year for family-related expenses, family-related to child care or adult care related expenses, and parking up to $270 a month for that, or commuter transit benefits if you happen to be able to take a bus or train. very nice to pay for that with before tax dollars, so it's an immediate deduction to you of your marginal tax rate. Occasionally you'll see long-term care and legal services offered, and other benefits you might see are executive coaching, payment of student loans, and employers that will offer education funds for up to $5,000 a year, but that does have to be spent on your current profession. That cannot be used for training into something new. That's how the Internal Revenue Code defines that. Equity compensation. So where offered, take advantage of it to as great an extent as you're comfortable in doing and as your financial circumstances allow. Reason being is it really forms one of the 5 critical paths to wealth creation. So there's the good old-fashioned savings from your earnings, be it qualified, that's US speak for retirement savings, versus non-qualified, as in after-tax savings, or non-retirement savings. There's, of course, investments, which could be real estate or other collectibles or equity investments, wealth gains through entrepreneurship and business ventures, stock-based compensation, which is what we're talking about right here. It comes in many forms in the US, including stock options. There may be qualified incentive stock options or non-qualified incentive stock options, restricted stock units, which are more common these days, employee stock purchase plan, where they give you typically a 15% discount off buying the stock public on the public capital markets. And we heard just last week, Goldman Sachs actually offers a PSU, a performance stock unit, that is based on outperformance of competitors on certain key metrics and ratios. I've yet to see any clients that have PSUs, but no doubt they'll be more common in the future. And of course, lastly, it's inheritance and gifting. With stock-based compensation, it's very important to be mindful of the taxation of that. And that's where dealing with a qualified CPA is really going to be to your advantage. Speaking of dealing with qualified CPAs, be sure to use an expat-specific tax return preparer. Doesn't necessarily have to be a CPA. I've had good experiences with CPAs. Sometimes the code gets too complicated, particularly with expats, if you're dealing with someone that maybe doesn't possess that level of qualification. So I don't mean to be discriminatory to folks that aren't CPAs. It's just been my experience that those are the people that do the best work and understand the nuance and complexity of the code. Point being made. So the US has a global income tax system, and that is they want to assess tax on all income if you are a US tax resident. So we have to revisit something that we covered in our last webinar. And there's many tips and tricks to being compliant, of course, as I alluded to a moment ago. So the US allows for foreign income tax credit, which is to say that taxes paid on foreign income will be recognized by the IRS, and therefore you won't have to pay taxes twice, or hopefully you won't have to pay taxes twice. There's also exemptions, but it's important to know that Social Security taxes don't qualify for this credit. However, this is dealt with separately under the totalization agreement, where if you've qualified for US Social Security, 40 quarters of qualified income, that means you're going to get a US Social Security benefit, which I'm very pleased to share with you, and I've learned that I need to make this known. It's not means tested. The US Social Security is not income or asset tested, unlike in Australia. So Warren Buffett is receiving a Social Security check. I meant to mention there, Medicare, the US healthcare system for folks over the age of 65, is not included in that. So if you are approaching your late 50s or early 60s and thinking about a move to the US, you need to be mindful of what you're going to do for health insurance. So don'ts in the US. Let's move through these. Don't get unintentionally caught in the US global tax system. It's not to say don't ever get caught, just don't do it unintentionally. Don't make long-term commitments while uncertain about your long-term domicile. Don't leave the US with after-tax investment accounts lingering about. Be wary of cash value life insurance. Be very mindful of self-directed IRA for property purchases. and be wary of cashing out your retirement plan. So let's get into the don'ts. Don't obtain a green card and overstay the 8-year rule unintentionally. So if you do that intentionally, you've met someone or you have a great job and you want to stay, hey, by all means, life has got to dictate the financial decision. But don't unintentionally linger about for another year or two because you haven't quite experienced one last summer in whatever city you happen to be in, because you will get caught up in this 8-year rule, which will essentially, if you get out of it, you've got to go through the exit tax process. So we need to be mindful of a couple definitions here. There is the legal and definition of there's a legal permanent resident for immigration purposes. That was the word I was looking for immigration purposes. And then there's tax resident. Different things. Let's not confuse the two. So immigration versus tax. To become a tax resident in the U.S., it's as simple as getting caught up in the substantial presence test. And here, I've copied and pasted this from the previous presentation where I will have gone into this in more detail. Essentially means 31 days in the current year and 183 days, comprised of the 3 prior years where they credit all the days of the current year completely, 1/3 of the current of the days in the previous year, and then 1/6 of the days 2 years before that. So very quickly, you'll find is in 183 days in the current year, you will find yourself subject to that. You'll be a U.S. Tax resident and therefore immediately subject to the global tax purview that the U.S. has. Here's the 8-year rule in a little more detail. So the IRS, if you're a green card holder or citizen, they look back in the last 15 years and see if you stayed for 8 years or longer, you may have to pay this expatriation tax. It won't catch everyone. It's typically for higher income earners, and it applies to those who earn over $161,000 a year in 2016. Index for inflation, that means increasing every year, or you had a net worth of more than $2 million with unpaid U.S. taxes. The expat tax is levied on your worldwide income with certain assets excluded, and you get a credit for the first $693,000 of gain. However, you lose your exclusion. For a married filing joint, your primary place of residence is given a tax credit of $500,000 and the sale $250,000 individually. So therefore, married $500,000, you would lose that in this event, in the 8-year rule, paying your expat tax, your exit tax. Okay, don't make long-term investment decisions without having a clear expectation of your domicile for at least the next 5 years. And the reason why we say that is to do with equities, that's stock market investments. You're looking at a reasonable holding period of 3 to 5 years as a minimum to begin with. And if you head off overseas, and we see this all the time, clients, because of FATCA and the various obligations that the IRS imposes upon U.S. tax residents, wherever they may be, they require these foreign institutions to comply with and report in a manner that is that satisfies the U.S.'s methods and formulas for how these things should be reported. Consequently, these brokerage houses will simply close your account if you're not of a certain asset level. And I've seen at a couple places $2 million is that number, that it's worth them going to the trouble and hassle of being compliant in reporting for you while you're overseas. So more commonly than not, they'll just close your account straight away. Okay. Continuing on with this point about don't make long-term investment decisions under uncertainty. Next one is real estate. Why? Because the payback period for owning real estate in the U.S. is approximately 8 years. It's not 8 years on the dot. It varies property by property, state by state, but that's about what you're looking at to make your money back. So we need to factor in there, you're looking at transaction costs when buying and selling real estate of about 6%. That's your realtor's commissions getting paid there. And the point above that is if this is in fact your primary residence, as I mentioned earlier, you'd want to stay in there for 2 years to have that $250,000 single or $500,000 married filing joint capital gains exclusion in the event that you do sell that property and have a significant gain. That would certainly behoove you to stay there that long. What we need to be mindful of when thinking of investment property is really considering what are all of the expenses that are going to be involved. First, you're looking at 1 to 1.25% property taxes that the state government or the county will be collecting on your property. Homeowners association, insurance, repairs, accruals, vacancy allowance, advertising expense, management. Factor all of that in, and in the current environment, it looks very difficult to find a property that is cash flow positive right out of the gate. Next, be careful with variable annuities. Variable annuities, they can sometimes be good. There's certainly a vintage from the late 2000s that were pretty good before interest rates really started to come down. But generally, they have what are called long surrender periods. That's to say, if you decide to cash out, you don't get 100 cents on the dollar back. They're still amortizing certain expenses that were incurred when you purchased that thing. Better off with a no-load variable annuity, which means it doesn't pay any commission at all, but still gets you that tax-deferred growth environment without having to pay a surrender fee. Another asset class to avoid, illiquid partnerships. Typically, you'd see this in real estate investment trusts. It's going to be very difficult if you're overseas and you have no liquidity and cannot exit from something that may be incurring great administrative headaches and taxation headaches as well. Next one, obtain cash value life insurance. Do not obtain, let's be clear there, do not obtain cash value life insurance. It's really not as simple as that, but it's very rare to find someone who has a genuine need for permanent life insurance. In my career, I've come across 3 clients everywhere I have said that this really is a good idea for you, and for everyone else, no, it's suboptimal. There's other things that you could do with your money that would be better. And here's why. As you get older, your insurable, this is why you don't need this form of permanent life insurance. As you get older, your insurable needs decline. As you pay off the house, save for the kids' college, save for retirement, as a result of an early death with dependents, young children, big mortgage balances, your insurable needs are declining. We need to also keep in mind that the estate tax, as of 2015, I believe it was raised to $5 million per person. So with inflation indexing, now between a married couple, you're looking at $11 million. You need to have an $11 million estate before you're on the hook for the 40% estate tax. So while cash value policies can make sense for higher income earners, and those are the 3 examples that I was referring to earlier, it really is one of the last places to go for tax-free growth. And here's some more reasons why. You have a very long funding period required to build up sufficient cash value that you can overcome the internal policy charges. It's life insurance, so you need to buy the life insurance and have the expense of that death benefit in the contract in the first place. So that is another factor eating away at your cash value and having it otherwise grow in a tax-free environment. Health underwriting is required, so we're talking about medical underwriting and all that involves. So if you're not in a very healthy state, then it can really increase the charges, decreases the attractiveness of this as an investment. Therefore, I tend to really limit this only to the clients that are rated in the best category, with the best health rating for life insurance. And as per the gain treatment, if you are no longer a U.S. tax resident, I have to punt that over to my good friends, the tax attorneys or the CPAs on that one, because it gets very, very complicated very quickly. Going back to the point there about funding priorities and where a variable annuity or cash value life insurance come into it, this is typical advice. This is the whole presentation here is general advice, not specific to anyone, but let's say we're dealing with a hypothetical client, resident of California or New York, married filing joint, earning $550,000. So in that highest income tax bracket, and they have children in daycare. This is the general order of funding, of the priorities of how to fund these accounts. So first of all, you have your retirement accounts where you're getting a tax deduction. Whoop, excuse me, sorry. Next would be flexible spending accounts, again tax deductible for childcare, healthcare. Backdoor Roth IRA, so this is no longer tax deductible, but you're taking money off the table that would have otherwise been subject to ordinary or capital gains tax and putting it in a tax-free environment, very similar in Australia to a non-concessional contribution into a superannuation account. After-tax long-term capital gains, this is advantageous due to the spread between your ordinary income rate and your long-term capital gain rate. Currently, it's at 23.8% for the highest income earner, plus your state rate. And so in California, I was just doing this recently, 33.1% is your long-term capital gain rate compared to above 50% for the ordinary income rate. So there's a 20% delta right there between those different types of tax asset classes. And lastly, right at the top, the last thing to fund, if you've got the cash to do so, would be either a no-load variable annuity or a cash value life insurance. You can see that they're tax deductible, those aren't tax deductible. So, self-directed IRAs, another don't. Major structural disadvantages, leveraging debt alongside your self-directed IRA investments can be difficult, potentially so costly as to outweigh the IRA tax benefits. Property's got to be managed by someone else. Otherwise, this could be deemed a non-compliant investment, and the entire investment would be subject to ordinary income tax rates plus 10% penalty tax. So a horrific consequence if you fall foul of these rules. Also keep in mind the custodians that will actually report on an asset such as this, they're not receiving any other compensation whatsoever, so the account keeping fees tend to be very high. All the usual questions to ask about real estate investments, and that's to do with, do you have the expertise? Do you really know what you're doing in this particular market? Are you prepared to deal with the accounting and taxes that will come with your changing domiciliary situation? And of course, management. That's another thing that needs to be baked in from day one. If there is some uncertainty as to where you may otherwise be, or alternatively, if you are going to manage the property, unless your hobby is dealing with difficult neighbors or problems around the house, then you should probably consider the cost of your time in doing that management. Lastly, don't cash out of your retirement plan prior to age 59.5. Withdrawals prior to that age are taxed at ordinary income rates plus 10%. As we see there. So if you receive a check, this happened to me before, I'll confess, not too proud to confess my own mistake, before I got into this business, I finished with an employer. They mailed me a check for my 401k contributions, and I thought, okay, beauty. I didn't know there was this exemption where if you're no longer with an employer that you get your 401k money cash in hand. Well, you don't. You've got 60 days to deposit that into another IRA or 401k. Otherwise, you get hit with ordinary income tax plus that 10% penalty. Also, be very wary of borrowing from your 401k. It is, some plans allow you to borrow up to 10%, sorry, correction, up to $10,000 or a maximum of $50,000 for other investment purposes. However, if you are to leave a job, then that is due. That full loan amount is due back within a couple of weeks of leaving that job. So that could cause some very complicated situations if it was tied up in some illiquid investment. A couple downloads if you're interested, please go to my website, arate-wa.com, and under media you'll find our key financial data from 2017, and also I've got a white paper there, a guide to incentive stock options, and then also the other white paper that I mentioned on the critical and chronic care rider for term life insurance. And that's it. Brett, I will hand that back over to you.
Fantastic. Thanks very much, Ashley. And I think you hit on some very important points. We're getting a lot of questions coming through, especially surrounding 403Bs, 401Ks, and those sort of things. So I think rather than delve too deeply in the presentation, we'll certainly do a deeper dive through the Q&A after towards the end. So what I'd like to do now is I'll sort of provide on the complementary side to what Ashley's covering off on, and that is the financial issues that Australian expats face who are based in the US, but obviously with respect to what's happening in Australia. So I'll just bring up my screen there. Ashley, can you see my screen?
Not yet, I can't.
Okay, that's not coming up there.
I see the Aussie Expat webinar.
Okay, fantastic. That's all we want to see. Okay, so obviously what we're going to do is cover off on, and then before I go any further, the best way to sort of, I guess consider what Ashley and I are trying to achieve is, it's almost like a Pan-Pacific type of a solution. So if it relates to a taxable issue or an account issue in the United States, that's what Ashley's really trying to cover off on. In relation to the service that we provide here at Atlas, anything inside Australian territorial waters is sort of our sandpit. So as Ashley alluded to before, nothing like starting off with the fine print that relates to any sort of financial presentation. Just to give you a quick summary of this, that virtually says that everything is general in nature. We haven't taken into account anyone's particular circumstances when preparing this information. So who is our Atlas Wealth Management? We are the first and only Australian financial services firm to specialise in providing financial advice to Australian expats. We've currently got clients in over 18 countries. With respect to the United States, that is from the East Coast to the West Coast, New York to San Francisco, but also it never ceases to amaze me. We've got clients in some of the smallest towns in the smaller states too. So it's great that we're able to take this advice and bridge those geographical gaps. We've been nominated as a finalist as well as winning in both a number of domestic and international awards for the work we've been doing in this space. Who am I? I'm the founder and managing director of Atlas Wealth Management. We, from time to time, I guess due to the specific nature of the work we do, we regularly called upon by the press, both domestically and internationally, to discuss financial issues that are affecting Australian expats. We've been in Forbes magazine, Australian Financial Review, live TV with Sky Business News, the ABC, as well as a number of industry publications. Also, too, we are also called upon to contribute to the BBC, their blog post on financial planning, which is called BBC Capital as well, too. So let's get the show on the road. From the Australian side, what are the financial do's when it comes to managing your assets as an Australian expat in the United States? First of all, and this is probably coming from our conversations that we have with a lot of our clients overseas, take your financial obligations seriously. We know that finance is not exciting. We know that it can be quite a boring subject, but quite often when you first become an expat, you're more interested in Googling where you got to move to in the States, what are the great restaurants and bars in the area, the best schools for kids, and financial considerations are definitely at the bottom end of the decision-making matrix. So, there's a number of pushes globally to make the world a smaller place, and that's both coming from FATCA, which Ashley alluded to earlier, but also too there's actually a more of a global reporting scheme called the Common Reporting Standard, which, believe it or not, over 100 countries that are part of the OECD have signed up to, and that includes places like Barbados, Panama, all the usual so-called tax havens. Interestingly enough, though, the only country out of the major countries that hasn't signed up to this charter has been the United States. So, interestingly enough, the United States may actually become a tax haven for expats going down the track, because they have no reporting requirements back to Australia unlike FATCA, where Australian financial organisations have to report their data to the United States. So it's a great case of do as I say, not as I do. Superannuation, I thought we'd kick off this one because it's probably the most common asset that a lot of Aussie expats have back in Australia, and 9 times out of 10, when you're in Australia, you're constantly bombarded by advertisements and everything in the press talking about the importance of managing your super correctly. Unfortunately, when you do get on that plane, that noise does abate to a very quiet whisper, and usually that relates to more so getting quarterly or end of financial year statements. Up until now, a lot of expats have sort of just ignored their super obligations when it comes to being a resident in the United States. However, that is now changing with the advent of FATCA, but also too, there's a lot of technology now that is in between both the IRS and the ATO. So when it comes to data sharing, it's definitely there. The biggest concern with super would certainly surround the fact that the IRS has been incredibly, I wouldn't say negligent because it's quite a strong term, but I guess lacking in their guidance and judgment surrounding Australian superannuation accounts. Unfortunately, we've seen in the past from private letter rulings that the IRS has considered Australian super accounts as foreign grantor trusts. We've been in a vast number of negotiations with a lot of tax attorneys and tax accountants in the United States, and they've all got their own interpretations of how Australian super should be categorised. Whether you're able to get it categorised as private social security or a number of other different methods, the biggest problem you've got is that's the actual superstructure itself, but also inside super is another issue that is certainly the biggest problem for expats, and that's the PFIC designation. So PFIC stands for Passive Foreign Investment Company. Those out there who've got super, and I dare say the vast majority of those who are on tonight, would have it. Just cast your mind back to the last time you looked at your statement, and when you looked at an AMP or an Australian super or any of those sort of statements, you've actually just got a line that says you own so many units in the balanced option or the growth option. These things are what's considered a PFIC, because PFIC means it's a offshore investment entity that is not in the business of being in business. So it's not like an ANZ or a BHP or a Telstra. All they are is a managed fund type investment that is pooled, and I'll go through later and talk about the categorisation of the PFIC. So how do you structure your super correctly? Avoid investing anything in your super that can be considered as a PFIC. The second point is keep turnover to an absolute minimum, which is very difficult for a lot of super funds because you actually have no control over that. The super landscape has changed a lot in the last 5 years, where you are now able to control what's actually occurring in your super account. So I definitely encourage you to investigate the options of doing this. And the third one is review your contribution strategies towards super. Quite often there's a problem, and I guess it's brought on by the popularity of maybe a self-managed super fund in Australia. Everyone's doing it. Half the people aren't sure why they're doing it, but their accountants recommend it, so they follow along blindly. Unfortunately, what happens is when you move overseas, there is a very real risk that when you do move overseas, that your Australian super fund, self-managed super fund, may be deemed non-compliant. And this is, there's a lot of ways that this occurs, but one of the main ways that people get caught out by is actually contributing to their self-managed super fund. What this does, it in turn triggers you as what's called an active member. As soon as you become an active member as a non-resident, then your super fund, self-managed super fund, may become non-compliant. So, super is not something to be ignored. We often joke with clients that, when they say, and then quite often, people will talk about modest balances, nothing too major, but, we often say to clients, if you saw $20,000, $50,000, $100,000 sitting on the ground, would you pick it up? And, of course, the answer is always yes. And the same thing with super. By and large, if you are intending to return to Australia, or even if you intend to stay in the United States but maintain an Australian super account, this could be quite a large part of your funding vehicle when it comes to providing for retirement. So it's the little things done now that make up the big difference later on. but unfortunately also if a super fund is mismanaged, both the Australian and US tax implications are quite large. Property, and this comes from a lot of conversations we have with clients over the last 12 months, especially those who are new to becoming an expat. Now, property is very much part of the Australian psyche. Everyone loves it. We've certainly seen the property boom of late, but people don't understand quite often the tax implications of becoming a non-resident, and they just assume that the status quo is maintained whether they're resident or non-resident. So probably the biggest thing with Australian property right now is there was a change to tax laws back on the 8th of May 2012 where Australian residents are no longer able to qualify for the 50% capital gains discount. So what that means is and this is in relation to investment properties in Australia, not any properties in Australia that were deemed a principal place of residence. With an investment property, from the date you become a non-resident, any capital gains that you accrue during that period of time is taxed at 100% at the non-resident marginal tax rate. Now, the bad news with that is there is no tax-free threshold when it comes to the non-resident marginal tax rate, so it's 32.5 cents on the first dollar of capital gains. So it can be quite expensive. The other thing that catches expats out as well too is when it comes to time to return to Australia and they've bought a property overseas, they don't realise that their time overseas counts still as a non-resident tax period, even though they may sell the property when they're resident again back in Australia. So the best example of that is if you bought a property in Australia while you're a non-resident, you held it for 5 years as a non-resident, you moved back to Australia, you held it for another 5 years, and then you sold it. What happens is the period of 5 years that you were a non-resident, even though you're a resident again in Australia and you're selling it as a resident, that 5-year period is still assessable and taxable at the non-resident marginal tax rate. So some people believe they can avoid that the high tax rate by selling it as a resident. Unfortunately, that's not the case. The next one too is general investments. Now, these days it's quite easy to invest both in the US market and the Australian market, and quite often people have been probably swayed by just buying a managed fund or an ETF in Australia, thinking they're doing the right thing by investing that. Unfortunately, any of these types of assets are classified as a PFIC. So a PFIC is a foreign-based corporation that exhibits one of two conditions. The first condition is based on income, is that 75% of the corporation's gross income is passive, e.g. from investments as opposed to their own operating business. The second condition that determines a company as a PFIC is that at least 50% of the company's assets are investments. So to give you a couple of quick examples of what is a PFIC and what isn't, if you buy a managed fund through Colonial or AMP, that's a PFIC. That managed fund is a pooled investment, and the sole purpose of that managed fund is to invest in other assets. An exchange traded fund in Australia that is domiciled in Australia. So any of the type of ETFs that are popular in Australia right now is deemed as a PFIC. What isn't a PFIC is any operating business. So if you bought ANZ shares, Telstra shares, Wesfarmers, those are businesses that are in the business of being in business as opposed to being in the business of investing in other businesses. So, there are a number of ways to navigate around the PFIC issue, but it is incredibly complex. Why investors should be worried about having an investment classified as a PFIC is that all income, including capital gains, is automatically taxed at the top individual tax rate. That's at the federal level, and even if your income level is below that, and your tax margin rate is below that, it doesn't matter, you'll get taxed at the top rate. And furthermore, any capital losses cannot be carried forward or used to offset other capital gains. So as you can see, a lot of the benefits of investing suddenly get sucked out of the decision-making matrix when it comes to do you invest and do you not invest. So this is where, when you combine this slide with the super, as you can imagine, if you did have a PFIC inside super, suddenly you may be having crystallized gains inside super that is actually not only being taxed at the personal level in the United States, regardless of the fact that super is preserved in Australia, but also too, it may be taxed at the highest rate and you lose any of the capital benefits of holding any sort of assets for longer than 12 months. So definitely need to take care of when you're selecting your investments. These days it's very easy to open up an online account and just suddenly put some money into an ETF or a managed fund. The devil is definitely in the detail there. So what are the financial don'ts? Now, don't stick your head in the sand. You know, quite often the adage that we get from a lot of clients is, I haven't been caught in the past, so how are they going to catch me in the future? The legislation wasn't there in the past, but more importantly, the technology wasn't there in the past. The best way to think of the IRS and the ATO are now like big computers, and all they do is share data between each other. It's not going to take a long time for the IRS and or the ATO to find out your details. We've seen some pretty extreme examples in the past of the lengths that especially the ATO has gone to ensure enforcement. Now, probably the most recent one we saw was a gentleman who was declaring annual taxable income of $30,000 a year, yet when the ATO went and looked at his social media accounts, he was flying his family business class to Disneyland, and they came back to him and said, how can you justify these two dichotomies? So, you know, they are out there, they're enforcing it, and they're incredibly you know, more reliant on data to match it up. So, you know, that's the biggest thing that to us we're saying to clients is just because you haven't been caught in the past doesn't mean you're going to get caught in the future. And as we know with a lot of regulators, they love to act in a retrospective fashion. So they'll go back for the last 2, 5, 10 years, whatever time takes to, you know, enforce those new legislations. Certainly FATCA is an acronym that a lot of expats are becoming aware of. It's becoming a lot more part of everyone's focus. Now you've got Australian financial institutions providing all of your data back to the ATO, and then they are now using and passing that data on to the IRS. So, you know, definitely get on the front foot with this. It's not something to be sneezed at. We all know how incredibly sensitive the IRS are when it comes to enforcement. There is no grey area. It's either black or white. Don't ignore your savings. This is probably one of the biggest things that a lot of clients talk about. You know, when they go overseas, the first thing they do is they look at, you know, if they've got an Excel spreadsheet or back of a napkin, you know, here's my income, here's my expenses, great, I've got all this money available. What they're forgetting is that your Australian colleagues back in Australia every year are putting away 9.5% into their super funds every year. So unless you're either matching that or trying to meet that sort of savings rate, whether that's contributions into 401k, personal savings, or making further contributions back into your Australian super accounts, at the end of the day, you need to be putting some money away. Now, it's very difficult with the cost of living going up to ensure that savings rate, but the biggest risk that you run as an expat is when you do, you know, come back to Australia, if you do intend to return, you actually want to have something to show for when it comes to your time away. Not just great stories and photos, but you actually want to be able to put your hand on something and say, you know, here we go, you know, we had a great time overseas, but also to our personal savings or our super or our 401k and now worth X. Do not ignore the currency risks. This is probably the biggest thing that, you know, expats choose to ignore, and quite often they choose to ignore it because they think they have no control over the matter. At the end of the day, at Atlas, what we often say to clients is you want to accumulate wealth in the country you intend to return to or retire to. Ashley covered off on, I think it was one of his first slides, that, you know, unless if you are looking to make the US a permanent home, then you want to accumulate assets in the US and in US dollars. If you intend to return to Australia, you don't want to be accumulating assets in another country or currency apart from Australian dollars. And the reason for that is when it comes time to repatriate back to Australia, you don't want to make that decision based on whether the currency suits you or not. Last year with the Brexit vote, we saw what happened there. Since then, the pound has fallen 16% against the Australian dollar, and we actually now have a number of clients who are stuck in the UK because they accumulated their wealth in pound sterling, and when it came time to move back to Australia, the numbers were too large to make that justifiable. So we almost call them expat refugees because they are stuck in these countries. Whereas if you accumulated, you know, your wealth in Australian dollars while you're overseas, then when it comes time to repatriate back to Australia, it's just a simple choice of, okay, now's the time, because your money's sitting in Australia waiting for you. in the correct currency. We've seen a number of economic and macro events over the last 5 years which involve massive swings in currency. We saw, previously the Swiss National Bank depegging the Swiss franc against the euro. The Swiss franc appreciated 40% against the euro in 18 minutes, and by the end of the trading day, we actually saw an 18% appreciation of the Swiss franc against the euro. So a number of companies actually went bust over that. We often say to clients is, the big end of town, they spend a fortune, hundreds of millions of dollars every year trying to work out what the currency is going to do, and they get it wrong. So if they're getting it wrong with all those assets and all those resources at their disposal, how can you get it right? And what we often talk about is, dollar cost averaging, repatriation strategies that, you can look at to try and smooth out the currency fluctuations. There's no way of determining exactly what's going to happen next month, next year, next 5 years with respect to the Australian dollar or the US dollar. So the best way to do that is every month or every quarter to start transferring money. Some months you'll get a better result than others, but over time you'll actually get a more of a smoothing effect. And we had this case recently where we talked to a client about that sort of strategy, and he didn't believe it because he'd been in the States for 10 years, and combined with the Australian dollar going above parity and all these other types of events, he didn't believe that if he just did it blindly, even during that time when the Australian dollar was very strong, that he would be better off. And we crunched the numbers, went back for the last 10 years, and if he made a transfer on the first day of every month for the last 10 years, he would actually achieve a conversion rate of approximately 74.55%. Now, right now the dollar is sitting at about 76, so it's not too far off, and when you consider the wild fluctuations we've had in those last 10 years, it's a great case to show that a repatriation strategy that is disciplined and unemotional can be quite a good strategy. So right now, what we're going to do is, we're getting a ton of questions coming through. So I'm actually going to wrap up my side because I'd rather, answer particular questions. Certainly Ashley and I have both covered off on the major macro points. Just want to put up on the screen here from a contact detail point of view. We'll be sending out after the seminar a copy of the recording, but also to our contact details. But if you've got a pen and paper and you'd like to know our contact details, there they are right now. So what I'm going to do is I'm actually going to go back and put both Ashley and I onto the screen, and we're going to start answering some questions here. So Ashley, are you there?
You sure am. Can you hear me?
Okay, certainly can. So right now I'm just going to close down those ones there. So we should be back onto two images there. So let's start running through some of these questions because they're very good questions, and I think we're going to see a lot of questions surrounding the same sort of things. So let's start with the first question. Murray, he says he now lives permanently in the US and has a 403B, which is in brackets another 401k. Is it wise to continue contributing to a superannuation fund in Australia? So I'll hand that question over to you, and then what I'll do is I'll answer it from the Australian side too.
I think it depends on two factors. It depends on is this so 403Bs for everyone. These are essentially 401ks for non-profits and for government institutions. If it's an Australian-based non-profit that happens to have a US branch office, and you are essentially paid as an Australian but overseas, yet somehow you have the ability to contribute to a 403B and the ability to contribute to your superannuation, that's one scenario that we need to be mindful of. Compared with returning, where do you see yourself being in the long run is I think the most important question to ask yourself in answering that one. If you see yourself back in Australia, by all means, continue to fund that. Otherwise, the 403B would be the place. The thing with the superannuation account, however, before reaching preservation age, is it's extremely difficult, if not impossible, to get your money out early from that, compared with the 403B, where there is in fact a backdoor way of getting your money out before retirement without penalty taxes. You still have to pay ordinary income taxes, but you can avoid penalty taxes if you utilize substantially equal periodic payment approach.
No, I think you highlight some good points there, because to me it's almost the simplest answer to provide, and that's you want to accumulate money where you got to retire to. So in this case here, Murray said he permanently lives in the United States. So obviously based on the tax rules being in favour of a tax resident in the United States, you'd have to say that obviously accumulating money in the States does make a lot of sense, as opposed to someone who is going to live in the States for the next 5 years but intends to return back to Australia. Then all depending if what age they are at as well too, if they're getting close to that 59 age bracket when you can start to draw money out of a 401k, that may sway them. But if you're 30 or 40 years old, then certainly the preservation rules surrounding a 401k, like with super, may sway your decision either way there. Now, next question we've got here is from Emma. So she says, I'm soon to come back to Australia after 5 years in the US. What considerations and how do I bring back the 401k? I'll throw that over to yourself as well there, Ashley. I think you touched on a few points there, certainly regarding the rules surrounding the age of 59, but what are the considerations that you got?
Well, to be honest, Emma, that's a very complicated one to answer. What I can say is, and actually Brett alluded to a point to do with this earlier, and that is that each different tax attorney and CPA that specializes in this field has a different opinion about it. However, the current the opinion that I subscribe to is the tax treaty treats employer-based retirement accounts differently to individual retirement accounts. So the word to the wise there would be, do not roll that out into an IRA, leave it in a 401k, and that may enable you preferential treatment for moving that back into a super fund. And Brett, you probably have some points to add to that.
Yeah, look, there's actually quite a number of strategies you can look at, certainly with respect to what's called non-concessional contributions, and we have done a number of these in the past, where a US resident who has met that 59 age requirement has drawn down his 401k, then actually made it as a non-concessional contribution inside super. Then we've also got other clients too who are in their earlier years who don't want the ongoing hassles of trying to manage a 401k from afar, and they've actually just paid the freight and paid the tax on an early redemption. So I think there is no right or wrong answer when it comes to what people choose to do, but obviously there's better and worse type of outcomes when it comes to managing those two. Quite often we actually have the comments from clients where they actually like to, even though they've come back to Australia, they'd like to have a foot in both camps and a bit of a diversified strategy, and they actually maintain a 401k even though they have repatriated back to Australia, because they do like obviously having that exposure in the US. Even though these days it is quite easy to get exposure from the Australian markets, people like to have that. Obviously the caveat with that is make sure that if you do return to Australia, make sure you declare it to the ATO, because it is an overseas asset when it comes to disclosure. Sophie's also come through here with some other questions as well too. She wants to go over the 401k in more detail, particularly if you only have a 3-year plan in the US and then plan to move back to Australia. So I think that we just covered off on that with the previous question from Emma.
There's another point that I would add, if I understood the question correctly, and that would be if there's an employer match, that's essentially free money, then if nothing else, you'd want to make your contribution equal to your match. If even if you're only going to be here for a short time, get that free money and let it ride.
Yeah, and then a lot of these questions can actually be solved out in a very simple Excel spreadsheet, can't they? I mean, I always default to Excel myself, but if, as you say, if you are getting an employee match and you are getting some free money, and certainly your demographics suit that decision as well too. If you're 22 years old and you're a long way off 59, then you still got to have that conversation. Do you want to have 2 retirement accounts accruing over time? And that's, once again, it's probably a bit more technical than we go into here, because there's a lot of different reasons personally why someone would or wouldn't go into that type of scenario. So hopefully we've covered off that one there. The next one is a question from Sarah. She's asked 2 questions. Any tax return tips if you're still a non-resident alien? And secondly, can you explain what expats with HEX debts need to be aware of? So I'll start that question and then I'll throw it back over to Ashley. On the tax return point of view, from an Australian point of view, unless you've got Australian property or taxable real property, there are no requirements to lodge a tax return in Australia. But obviously, when it comes to the US, Ashley covered off on very well before about working with a US accountant who's cognizant and sympathetic to being a cross-border type financial life. When it comes to HEX debt, this is something that we've been beating on about for the last 12 months, actually probably a bit longer, and it is a big issue that a lot of expats still to this day aren't aware of. Long story short, with HEX or help debt or a TSL debt, up until 30th of June this year, as a non-resident, you haven't been required to make repayments on that debt. As of 1 July, bingo, it's all going to change. So the party's ended, and you may or may not be surprised by this, but the ATO have been incredibly quiet on the mechanics and the process behind this, and to the point where I've actually had a number of conversations with the ATO. Believe it or not, one lady tried to convince me that expats don't have to make repayments after the 1st of July. So if you are speaking to the ATO, probably drill that point home, because there is a chance that you might get confused a bit. But long story short, you're going to have to lodge a quasi tax return with the ATO to declare your worldwide income, and then based on that, what's actually going to happen is they're going to assess you based on the thresholds that exist in Australia. I'll actually send out a link after the presentation to where people can look at those thresholds. But long story short, they're going to hit you with a bill. In terms of the mechanics behind that, right now, from what we can see, the ATO is going to try and funnel everyone through the MyGov web portal, which is where a lot of government services now access. The problem with that is, if you have been an expat for a while, the way that the portal is set up is it defers to an Australian resident who has an Australian mobile number, 2-step authentication when it comes to receiving a PIN number. Unfortunately, if you're an overseas resident, you don't actually have an Australian mobile number, so there's a problem with that. So, we could not get a straight answer out of the ATO at all, so we actually went online and tried to set up ourselves without using that. So on our YouTube channel, we've actually done a screen share of how to set up a MyGov account without using an Australian mobile. The other point too is, for those people who already have a MyGov account that was set up in Australia and then you move overseas, you need to be very careful, because unless you turn that security function off, the next time you try to go into that account, it's going to try and send you a PIN number to a mobile number you may not already have. So there's a lot of complicating things there. We've only got until 30th June to get everything squared away. The other thing I'd like to point out too is, if you do have a HEX debt, and it's very simple to work out rough numbers of what you may owe, start putting money now. Don't wait for that bill to come from the ATO, because they're not going to give you 12 months to pay it off. They're going to give you a bill, and you're going to have a very short amount of time to pay that. Coming in here to John, who's asked the next question. If I don't know when I'm going to retire, but assuming it is either the US or Australia, should you consider contributing to both a super fund and a 401k?
Well, it's a fine question, so you don't know your domicile. You have no idea about that. I would lean in funding the retirement account in the country in which you're currently in. That would be my advice. Brad, where would you go with that?
Yeah, look, I think that certainly makes sense. One thing we've learned with dealing with expats over many years is plans change. The amount of times that clients have looked me in the eye and said, we're here permanently, and then 2 years later they say, guess what, we're going to England, or we're going to Australia, or plans change a lot, and I think it's very difficult to determine what the appropriate strategy is. I think John's sort of taking a foot in both camps type approach. So I think the biggest thing that we're seeing right now is the goalposts, more so in Australia than in the United States, with regards to super, is changing quite a lot. So how super is going to look in 10 years' time, let alone 20 years' time, is very different from now. We actually saw the Australian government do a double backflip with super last year in the space of 3 months. So if that's occurring in that sort of amount of time, what's going to happen in the next 3, 5, 10, 20 years? So, maybe not actually contributing to a retirement account, maybe actually contributing just to an investment account in his own name. There's a lot of different scenarios there because, certainly flexibility, liquidity, these are all key issues as well too. So, I'd say to John, investigate the opportunities. Do you go along with the flow with the 401k, or do you actually look at something else? It doesn't have to be a pension account or a retirement account. It could be a lot of other options as well. But as long as you're putting money away, that's the important part.
Another interesting opportunity we came across in looking through the tax treaty in detail is the possibility of investing in a U.S. Annuity. And when you are domiciled in a different country, you are subject only to U.S. federal tax, provided you relinquish your domicile to a particular state. And that in itself is a complicated topic, but these states, they're all desperate for money. They're doing whatever they can to get a hold of money from expats. If you don't take certain steps to say that you're no longer resident in that state, then you may have to pay U.S. state taxes. So part of proper planning would be to relinquish your domicile to a given state. And in the example, building on what Brett was just saying a moment ago, if you were to purchase an annuity, you would then find yourself in a higher tax environment like Australia, but only paying the much lower U.S. federal rates. They're lower brackets in absolute terms, and the amounts at which the brackets step up to the next threshold occur at higher income rates than what they do in Australia. So that's another, I guess, a backdoor kind of hack right there.
Definitely. Just getting through these questions, Rebecca's asked the question about what are the implications of maintaining a primary residence in Australia while being resident of the United States? And I think this sort of comes back to the 6-year rule with respect to if you have a principal place of residence in Australia, as long as you don't allocate or nominate another residence overseas as your PPR, that you do get that 6-year window when it comes to a capital gains tax-free type environment. Certainly, if you are maintaining that residence, you will still have to disclose that residence to the IRS. The fortunate situation is there is a double taxation agreement between Australia and the United States. So the United States does recognise the tax treaty between Australia and also the tax implications that are levied by the ATO. However, in saying that, and Ashley's nodding his head here because he knows exactly where I'm going with this, the rules aren't always in favour with Australia, and we've seen the IRS sort of play around with a few things. Ashley, do you want to sort of cover off on a few points there?
Yeah, I thought you were going to say something different, and that was to do with, let's remember that the tax treaty is between the two sovereign countries. It's not between the individual states. So while the tax treaty might deal with the gain such that you're not taxed at the federal level in the US, you may well be taxed on the sale of your Australian primary residence by the state that you're in.
Yeah. So, and that's the problem about all those state treaties throughout the United States. I mean, you can move a state and suddenly your tax situation changes quite remarkably without doing a lot of effort yourself. So, coming back to Rebecca's question, obviously from an Australian point of view, and you almost need to quarantine your decision-making process per country. So from an Australian point of view, you do have 6 years. If that was previously a principal place of residence, once you go past that 6-year mark, then from that 6 year on, you'll be assessable from a capital gains tax point of view. But obviously in the United States, as Ashley covered off on the point quite well, you are going to need to take into account both federal and state tax implications as well if you're doing anything with that property. So, quite often, clients can combine the 6-year rule surrounding a PPR in Australia with what Ashley referred to earlier with the 8-year rule regarding becoming a covered expatriate. There's a lot of reasons to have that conversation with a financial advisor around the 5 and 6 year mark, because the ramifications change quite a lot at that particular point in time. Andrew comes up and says, what are the tax consequences of drawing on my super that is left in an Australian fund if he retires in Australia, retires in the United States? So Obviously, from an Australian point of view, Andrew, once you meet the preservation rules, you are certainly allowed to draw down that fund, whether that goes and buys a boat or a house, or you can do what you want with that. Ashley, do you want to cover off on the other side of it as well too when it comes to bringing that money into the United States?
That's actually, I've got to confess, that is actually a situation I haven't seen quite yet. We're planning ahead for one client in particular, but we have not encountered that quite yet as exactly what the tax treaty looks like in that situation. So I don't have anything to add, but I know that I would research that thoroughly and get to the bottom of it when that situation is upon me.
And I think we're going to see more and more of that coming up as we see an ageing population come through, combined with more and more Australian expats becoming permanent residents of the United States. It's definitely going to be a common part. And I'd actually say to Andrew, make sure you subscribe to both Ashley and myself on our respective social media channels and our newsletters, because what we often find is when we go through a scenario exactly like you just mentioned, and Ashley mentioned as well, if we have a client that comes to us with that problem, we go through and find it. But also what we'll do is then actually make everyone aware of the situation and how it's treated as well too. So definitely make sure you follow us, because I dare say that is becoming a more and more popular thing to be occurring in Australia. Elizabeth's got a great question here. She says, I see myself moving back to Australia. She's currently living in New York. Is it possible to access Social Security at retirement age if I'm living back in Australia? And she's referring to US Social Security.
Sure is. Yep, it sure is. They'll pay it wherever you happen to be. I love offering this bit of free advice, and that is, if you can wait until age 70, you'd be absolutely advised to do that. There's an 8% annual bump that's given payable for the rest of your life if you defer between your normal retirement age and age 70. There's no bonus after age 70, but the actuaries have done their numbers, and that's where they figure the cutoff point is going to be. So yes, you will get it in Australia.
Yep, and I think also to go on further that there's actually what's called a Social Security Agreement, which is an agreement that the Australian government has with a vast number of countries around the world. So it actually goes both ways, believe it or not, when it comes to age pensions in Australia being paid out to residents in the United States and so forth. So it is changing a lot at the moment, so more homework is required if you are looking at that, but the answer is definitely yes. Got a question here from Natalie. Is it true that if you become a US citizen and decide to move back to Australia, that you will still have to pay taxes and file your yearly taxes to the IRS, even though you are no longer living in the US? And I think this is the biggest, I call it bar question I get from expats, because there's a lot of bar talk that happens between expats, and they think, oh, yes, no, yes, no. I'll run it through with you, Ashley, first, because I know exactly what you're going to say here, and unfortunately the answer is yes, unless proper steps aren't taken.
Yeah, it depends on what income you're producing in the U.S., but generally the answer would be yes. However, whether you actually have a tax bill is another question, but it's really up to the facts and circumstances of your individual situation. So if you've got investment property in the U.S., then yep, congratulations, you get to file tax returns. If you've got other managed investments, then you're having to file. But if you only have, let's say, a 401k account in a tax-deferred environment as it is, then maybe you don't have any U.S. sourced income, but the IRS still wants to know that you've gone through the proper protocol and that you've taken the credits, that you've paid more taxes in Australia, and the IRS would deem that to be sufficient for the purposes of the double taxation treaty, and you mightn't have anything to pay other than your CPA for having to file the return in the first place.
The other thing, actually covered off a very important point there, where the US actually respects the Australian tax rules first, and then if there's any extra owing, sometimes that will come on top. The only caveat to that is, and we're seeing this with a lot of US expats based in Australia right now, is once again our friend's superannuation. Because the US government does not recognise super as a foreign pension, you've actually got the case of returnees, but also to US expats working in Australia getting hit with tax bills back in the United States for work that's actually happening in Australia, even though they live in Australia. So we have seen a lot of conversations in the last 6 months, especially post the Trump election, regarding should an expat get off an E3 visa and jump onto a green card. My comment to that always is make sure you go in with eyes open, because what a lot of people don't realise is if you do get a green card and you do get permanent residency in the United States and move back to Australia, it's not a simple matter of just leaving the country. Obligations do follow you, and that's even if you have no assets left in the United States. Certainly what Ashley covered on before with the 8-year rule, becoming a covered expatriate, that follows you as well. So you definitely need to do your homework and watch that. If you aren't a green card holder, but you have been there for close to 8 years, watch that date very carefully.
Just another couple. Yeah. Brett, sorry, just another couple of minutes, and I've got to go get moving.
Okay, so 2 more questions here. One's actually from Murray, which I can cover off on here. Regarding the HEX payment, he's been making voluntary repayments by MyGov. What will the structure of the repayments? Will it be monthly or annual? Murray, surprise, surprise, the ATO hasn't told us. Knowing them, it'll be just one big lump sum. You owe us X amount of dollars. Please pay this into this account within the next 30 days. And then he also goes on to say that the MyGov payment portal has been working properly for months. It's not just the MyGov payment portal, it's everything with the ATO, the whole computers, anyone lodging BAS, all these different compliance returns, they're actually having problems as well. So, that's been the biggest problem. Sophie's come up here as well. How do they find you to deliver the HEX bill if you're not on MyGov? That's actually an interesting one, Sophie, because the ATO hasn't told us yet, but knowing the ATO, with the amount of data sharing available, the ATO is now dialed into the immigration database as well, so they know people moving around. They are going to find you. We held a seminar last night our time, very early this morning your time, with doing a very similar thing to this with expats in Singapore, and expats in Singapore were telling us they're actually getting letters from the ATO reminding them of their obligations. So it comes back to one of my earlier slides. They will find out. Ignorance is not an excuse when it comes to meeting your obligations. I recommend getting on the front foot with this and doing the right thing for the start, because you don't want to be chasing your tail after that. So, right, I think that's covered off all the questions. So we'll let everyone go for the afternoon and evening. So once again, thank you so much to everyone for attending. We hope you got a lot of value out of this. We are recording this as well, and what we'll be doing is sending out a copy of the recording and also both of our slide decks. So keep an eye out for an email in the next couple of days with that information. Obviously, in that email as well will be the contact details for Ashley and myself. So please don't hesitate to get in contact. We're fortunate to deal with some awesome people as clients, and we'd love to work with you as well too. So thank you very much to all the attendees, and Ashley, thanks for your time.
Thank you so much, everyone. Thank you, Brett. All the best.
Have a great evening, guys. Take care.